Jill Shep with the Commercial Real Estate Executive Exchange. I'm here with Frederick Hubler with Creative Capital Wealth Management. We have some really, really exciting things to talk to you about today. Frederick was kind enough to join us. Frederick runs a creative financial management firm specifically involved in a number of different facets and representing clients of all industries and sectors. And we are excited to have Frederick today to talk about the Delaware Statutory Trust. Frederick is a very, very recognized financial manager and has been mentioned in the Wall Street Journal and USA Today several times. He's also been in Yahoo Finance a number of different times, as well as, today we're going to talk about how Frederick has helped various real estate developers and commercial real estate brokers make millions of dollars in his strategy surrounding real estate. So Frederick, welcome to the show.
Thank you. I'm glad COVID's over because we're right there. So this is awesome. Thank you for having me. This is awesome.
It's my pleasure, Frederick. So tell us a little bit about your firm, where you're located and when you were founded, and a little bit about yourself.
So founded 20 years ago. So it took 20 years to be an overnight success. Started in Valley Forge, which is the same zip code as Vanguard. And that began the thought that I wanted to be different because I couldn't compete with that. And so we focused on alternative investments, which 20 years later is what we're known for. So all of those accolades you shared, it's not because I'm a great guy, but it's also because of the solutions we have access to that most people don't even know exist, which a DST is one of them. We're going to talk to, I want your listeners to leave here with, I didn't know that existed, and now there's something that could help you if you're in the right situation.
Well, thank you, Frederick. I appreciate that. Yeah. So tell us a little bit about your sort of experience in the Delaware Statutory Trust and what makes it so amazing for people that are looking to maybe make some alternative investments in real estate.
Yeah, and so for the developers who need to buy real estate to develop, so let's say they're taking a C or B mobile home park or apartment building, and they want to they raise either their own funds they're doing it with, or they're raising capital from outside investors. The hook is you got to buy the property that you're trying to buy. And a lot of times, and this is the same thing for the realtors, the people with those properties would love to sell, like get out of the headache. They don't want another headache, and they don't want to pay taxes. Some of these bigger properties have been in their family for decades, 20, 30, 40 years. So it's depreciated all the way. There's really no cost basis. So if they sell it, it's all taxable. So where we step in is the realtor can sell it to whoever wants to buy it, and the developer can utilize us to say to their potential development they're going to buy, hey, if we can help you not pay taxes if you sell it to me as a developer, would you be interested in selling it to me? And so that has been we get calls all the time saying, can you talk to this family? $40 million mobile home park or $30 million apartment building, and they would love to sell, but they don't want to pay taxes. I would love to buy it, or the agent would say, I would love to sell it, and can you help them? So we will do this all the time for everybody, even if it doesn't point to us as the end. I think it's an education that they need to know. So what happens today is 14 years ago, the world realized that tenant in common structure doesn't really work. You got multiple investors, they all have to agree unanimously. And if your Thanksgiving was anything like ours, we didn't agree on what to have for dessert. And we're family. Mm-hmm. So imagine you get investors that don't know each other, they're not going to agree on anything. So 14 years ago, it was a Delaware Statutory Trust that utilizes real estate inside it was approved by the IRS. So this isn't a flyer. All of our clients are rich before they come here, and they don't want any gotchas. They don't want any gadget plays that may blow up at the tax court. So either you sell it to someone else and you do a 1031, or the developers buy it from the person they're trying, the property they want to buy to develop,
sure,
and they 1031. So it's still a 1031, but instead of a 1031 going from my headache to your headache, you sell your headache to, you sell the thing you're getting rid of, and then you become a partial owner of already built, already tenanted, already leased, already cash flowing real estate that you get to pick as. So they run the whole spectrum from, dialysis centers, Amazon distribution centers, multifamily, mobile home, like it's all storage, like any kind of real estate that new money's going into, not strip malls, not anything that's crazy. Retail, even if we do retail, it's got to be resistant and essential retail.
Sure.
So think grocery stores, Pep Boys type of places. Those places are going to be, even in a recession, especially in a recession, people that don't have a lease, they got to keep the car running to get to go and and to get to their job. So if it's retail, it's going to be, essential retail, but it's the whole spectrum. And so let's say you sell a $10 million property, the investor can cherry pick 10 different $1 million DSTs, way more diversified, because the new property, you're not an investor, you're not a partner, you are an owner of 0.0000 of whatever it is, depending on how big it is. These investments are never advertised. They're almost always sold out within weeks. So our job is to identify, and the analogy I use is an airplane.
Sure.
Is this DST the right airplane for the investor?
Sure.
Because one, you're not flying, and you can't get off.
Sure.
These things live about 5 to 7 years, and then the sponsor, who would be like a general partner, the responsibility, but it's not a partnership, the sponsor then sells it to a third party, and everyone who's in it gets 3 choices. You can cash out and walk away and pay your taxes. If it was a 1031, you got to pay your taxes going all the way back.
Sure.
Normally, no one does that. Nor number 2 is you can move your money from that DST into another DST, which we would help, with that, and we're very happy to do that. We get paid again, they get in another one, and I'll walk about how we get paid. And then the third option, and this is interesting for your more sophisticated investors, that third option is you can come out of a DST when the plane lands, and you can 1031 out of a DST back into an individual property you own personally. So you're not stuck with us, you're not stuck with DSTs. The reason we like it right now is if you and I look at a duplex in Phoenixville, for example, we're probably overpaying because there are probably 14 other people that look like us that all want that. Well, the institutional world is less frothy. A lot of it is as an example, if you're a big company and you've worked with a big institution to help you finance one building, you're going to go back to the institution to finance the second. You're not going to put it out in the market saying who can pay me the most. You're basically who can close this deal the fastest.
Gotcha.
With deals that we understand.
Does
that make sense?
That does make sense. Thank you so much for sharing that. So how can an investor, a potential investor, weed through all the investment options in the DST and then find out what's the credit quality of the investor, and how do you work the due diligence? How do investors and potential investors make themselves feel safe in these investments?
Perfect. Everything we do. So we are registered investment advisory, and we also are an investment advisory through a broker dealer. So we're hybrid, which means we have 2 different audits, and we have 2 different places looking at us. Everything that we put in front of a client is FINRA and SEC regulated. Doesn't mean it's blessed, and it doesn't mean they've accepted it, but it's not some guy's syndication out of his trunk, which sometimes they're good investments too, but we don't do them. Some of our clients are those guys that are doing friends and family capital raises. So everything we do is not only FINRA and SEC regulated, but as important, we do the due diligence on the sponsors. And the sponsors are names that you knew of before you ever knew about me, and that you'll know of long after you and I are both gone. These are huge institutions. They don't advertise to the public. They're names you would recognize, and privately we can talk about it. But if I say it, I'm sure the lawyers are going to say, please not name drop us. You can Google DSTs and see what's out there. You'll see a lot of the sponsors will show up as hey, these are the sponsors out there.
Sure.
The biggest caveat and the hardest part of my job is everything we do that's different than what you can get online, mutual funds, REITs, those types of things, are what's considered a restricted investment. So the investor, so the person, trying to do the DST, needs to have $1 million of net worth, not counting their house, which isn't everybody, but it isn't nobody. I mean, and again, if you're selling a $10 million property, you check that off. That is. So for the bigger real estate deals, it's a no-brainer.
Sure.
What I feel bad about are the people that have a $250,000 net worth and $200,000 in the townhouse that they're trying to rent and flip. They don't qualify. And it's not my world, and it's not my fault, and it's not my decision. It's a government program. You really have to have $1 million of net worth, not counting your house, or there's an income component of individual $180,000 or married $300,000.
Okay.
So that is the first, and that's really the reason no one ever hears about these things.
Sure.
Because they're restricted, so they're not allowed to be advertised. And each DST is different. So every DST we look at as a standalone, almost like a company evaluation. What's the property? What's the cash flow of the property? And is the cash flow, going to work when things don't work? And I assume things are going to get worse before they get better from an economic standpoint. So we are very conservative and we only work with what we feel are sponsors that are very conservative.
That's terrific.
I want them to under-promise and over-deliver.
That's great.
And that's their job.
Sure.
Because they will have, for our investors in the DST, they will have a replacement DST. When your DST comes in for a landing, they'll say, oh, if you like that, we have a new one. And we're not obligated to use the same company, but they make it easy for the investor. I love what you did here. I'll give you my money to do it over here in storage or over here in multifamily. The other benefit of a DST is if you do go into a DST that's retail, let's say, or that's storage, when that DST comes back to you to make another decision, you're not stuck in that asset class.
Interesting.
So it's still an investment property, but now it can be senior living or student housing, or
Nice.
it can go mobile home. Like you can do anything.
Sure.
So we look and see what's not as frothy and what's very defensive. The income's tax-free in almost every case.
Sure.
Income single digits. We're not getting 30% return income on it. And then the biggest return isn't just the income, it's when you sell it to the next party and get your capital back. And what you're selling is what's left of the 20-year lease, or you're selling the net present value of the cash flows if it's a multifamily or storage. But you also benefit from inflation when you sell it in the future, because it's going to be worth more in the future. And with inflation, two things that we're doing for a lot of our clients is putting some piece in storage and multifamily. Storage is awesome because you can change the rent daily. So if inflation gets ugly, rents get ugly, storage rents go up.
Sure, absolutely, absolutely.
And I don't see things going down anytime soon. I see the market, I see certain things going down. I don't see rent going down. I don't see, cost of renting going down. So, there's a lot of headwinds out there. Inflation for hard assets is a benefit.
Sure, absolutely.
A lot of places inflation is a bad thing.
That's a great thing,
Real
absolutely.
estate.
So if you're an investor and you've just sold a property looking to do a 1031 and you can't find a formidable qualified replacement property, this might be a great strategy for somebody that sort of warehouse this for a period of time and or make a permanent investment.
Or if they do find another property that's perfect, but it doesn't equal the exact numbers that they left, we can put them in a DST that makes the total transaction equal to what you sold.
That's terrific.
So if you sold a $10 million property and you only bought another $5 million property, then you just do a $5 million DST.
Absolutely.
So we can be an add-on after the fact and make sure the numbers. And some DSTs have no leverage, some DSTs have 80%. For that reason, to kind of fill the gap. So like a 1031, the equity and the debt have to equal or be greater than, the debt could be greater than what you sold. The DSTs come to kind of plug those holes.
Sure.
If the person still wants to be active. What we're seeing in the 28 states we work in is significantly wealthy families selling their marquee property. And I don't know if it's good or bad, but I don't think it's good when people are saying, I want to take my chips off the table.
Sure.
And I think COVID scared them. I think they realized real estate could be, at a very high level now, with interest rates going up, less people can pay, even the same price, let alone more price. So they're selling their 10, 20, 30-year-old property that dad's dad built, and they're going into DSTs because they want to be more passive. And I think in their vision, and I agree with them, having a partial ownership of a $300 million piece of real estate is a little bit more safe than your $10 million storage that you're selling.
Sure.
It's a different world.
Absolutely.
So moving towards more institutional real estate with a broader, either 300 million means there's a home. If it's multifamily, there's a lot of multifamily in that building.
That's great.
And almost all the DSTs are also fairly new properties. These aren't fix and flips. Every now and then a DST will be that has less income and more of an upside in the back, but we're seeing less of that, and we're seeing less demand for that. We're seeing people saying, I want decent income, I want to survive the correction and the election, and I want to make sure that when this DST comes due, it's going to be more money than I put into it, so I can do something else, 5 to 7 years later.
Sure. That's a really great strategy, it really is. So if you invest in a DST and you get, let's say, obviously you're investing in new real estate, how often or how long does it typically take to start receiving your sort of interest in the property? And then after that, and once you start receiving that interest, what's the strategy surrounding, the time frame surrounding, selecting the next property or deciding to exit that?
So every DST is already built, already leased, already tenanted, and your money is going to replace the sponsor's money. So they know before you even get into it what it's cash flowing. Because if it's a multifamily, you already have renters in there. If it's storage, it's already running. So these aren't buy it, hope people move in, and then we figure it out. What is unknown, if it's a a 20-year lease with an Amazon or a CVS or a multiple vendor, and some of the DSTs have multiple sponsors in there,
Sure.
especially the retail ones. You don't want to have just one retail outlet. There's a 20-year lease, so the income and the cash flow starts the very next month that after you put in, because now you're an owner, you get the rent.
Sure.
Starts the very next month, and is based on the cash flow of either the leases that are in there or the current tenants that are in there. So the storage and the multifamily, the income and the cash flow is the best guesstimate, because we don't know when people are coming. But if you're using very conservative sponsors and they're using very conservative numbers, and they're not playing with numbers like reserves, like there's ways you can make a DST look great, and one of the biggest ways by having nothing in reserve.
Sure.
Well, if you need something for windows and God forbid, planned obsolescence, things that will wear out, if you don't have the right reserve, you can't add more money. Like a DST is kind of a closed loop. So the reserves are important, and so we're seeing there's some sponsors today that didn't survive 2008.
Sure.
So the sponsors we use have history through 2008. They're low cost because they want that client to be a return client.
Sure.
And most people, and this is the other benefit of a DST, is if you swap until you drop, if you keep moving into another DST, at some point we're going to die.
Sure.
And when that happens, your family will get a date of death step up. So those capital gains you've deferred never get paid.
Wow.
Which is awesome. The lawyers hate it because they didn't do the trust to do it.
Yes.
Sorry, that's the way real estate works.
Okay.
So I think that was the one question. The other question is every DST will have a planned life cycle, typically 5 to 7 years. And what that means is they plan to sell in 5 to 7 years to a third party that will buy that cash flowing real estate that you're in. It may be lately, sometimes it's been 3 or 4 years. I don't see that happening.
Yeah.
The world's been really good in real estate for the last, 8, 9 years. So there have been DSTs that in 3 years they got a sweetheart offer, and they said, you know what, our job is for the DST owners to maximize the return.
Sure.
We're going to sell this for 2x in 3 years.
Sure.
I don't think that's happening anytime soon, but the sponsor is responsible for all of basically they want their baseball card of performance
Sure.
to be something that people are attracted to. So if they can sell early and get your money back, that's great.
Terrific.
And then the investor has that choice: cash out and pay taxes, roll into another DST,
Nice.
or 1031 into own property.
Very nice. That's very nice. Frederick, thank you so much for your
Thanks for
time
having
today.
me.
Sounds like a
Appreciate it.
really, really provocative investment opportunity for someone. And I would say to you, what's the best way people can get a hold of you if they have more interest?
Yeah, so I would say our website's the CCWMG, Cat William Mary Greg, and you can click on schedule an SOS. It's SOS stands for Second Opinion Service, and then just put in there, information about a DST, or I'm curious about a DST. If you're a qualified investor, we can send you some information. If you're a professional and you just want to know how this works, we can go into a closed deal and walk through how it worked and what the numbers were. My intent of being on your show is to educate. People don't know what's out there. They may not sell when they want to, or they may sell in 1031 into a new set of headaches, which they couldn't want to. And if they know that there's a passive way that they can become a landlord and keep all the landlord benefits, then I've done my job. Whether they take it or not is up to them, and we would help them, advise them. There's some people that's not the right fit, and we're the first ones in the room to say, you're doing a great job, and there's not a DST that will take on the risk you're used to taking on. So you're not going to get the return from a DST as you are with your risky real estate plays. If you're developing something and you're adding a ton of money and then you're selling it, that you should be making 3, 4, 5, 10x.
Sure.
DSTs aren't built to do that. They're
Right.
built to take chips off the table and have a very smooth glide path and tax efficient income and tax efficient capital.
That's terrific. Well, thank you for sharing that. What's a
Excellent.
typical yield that someone might receive on an investment?
So they tend to be, the smaller the yield, the smaller the income, the more likely there's a value add component. So we have, it's closed now, so we can talk about it, but it was a mobile home park, and the yield was only 4%. Now that's not that's not anything that's not great. Tax free, not bad. But here's the opportunity. That family that owned it didn't have the capital to build out the additional pads that it was permitted to do. So it was generating more than 4% of income, but they were using the income to build out the other pads, which means that 4% was year one money. And it's gone up to 6%, that same one's gone up to 6%, a couple years down, because now they have more pads. But more importantly, when you're able to sell something with 80 pads, but you bought it when it had 60, you're going to get more of a pop on the end.
Sure.
So the small, let's say under 4%, it's more likely to be a DST that has a value add component.
Sure.
And then the most we've seen recently with the current cap rates, current interest rate, current market is close to first year income of about 6%, 5.5, 6%. And that's just first year income. It changes from there. In almost every case it goes up. I haven't seen it go down. And I think with inflation and everything else, it won't go down from an inflation standpoint. With real estate, not only is it location, but the location and the property could be perfect. If you don't have someone in there paying the bills, it doesn't matter.
Right.
So it's all about who's the tenant, and the tenant has to have a vested interest in that property being better than their other alternatives, and that's what we look for.
Absolutely. Along with no headaches, right?
Yes,
Little headaches, should I say.
Right.
Exactly right. Well, Frederick, thank you so much again.
Thanks for having me.
Again, of course, absolutely. Again, we were Frederick Hubler, Creative Capital Wealth Management Group, and Bill Ship with the Commercial Real Estate Executive Exchange, and also with Victory Bank. Thank you so much for listening today. Hope you have a wonderful holiday season, and we hope to talk to you soon. Thanks again.
Thanks.